Brilliant. Thanks for joining us, Daniel. Listen, it's been a pretty crazy start to the year. A lot of volatility, a lot of talk about inflation, a lot of talk and some incredible inflation numbers, multi-decade highs, and the talk of the town is all around interest rates. Why is that so relevant for investors?
Thanks, Wayne. Look, I think it's really relevant today because of where we are in the different market cycles. So interest rates now have been effectively zero for quite a period of time, and we've also seen enormous amounts of quantitative easing from central banks all around the world. So because of record low interest rates, we've seen extreme valuations, and because of all this liquidity, we've seen quite aggressive speculative behaviour. It's definitely both are at extremes. And why inflation is really catching everyone's attention is inflation is potentially an indication of a turning point in those extremes. So if inflation is to rise consistently, which it looks like it may be right now, that may indicate a turning point in regards to interest rates starting to go up as central banks account for the higher inflation, which would be negative for valuations. And also, the higher inflation is probably also going to mean a turning point for speculative behaviour as well. And we're starting to see that both those things really play out in the early parts of 2022.
How would you describe the stock market today?
It's a big question. Look, up until a few months ago, there's definite indications of a lot of late cycle behaviour. Valuations, as I mentioned earlier, have been at extreme levels, but there's quite a wide range of valuations as well within the market. While the headline valuation metrics are very high, there's still a lot of companies that are trading at very reasonable multiples. And those companies, I guess, are the more established companies. A lot of these industrial companies that have been around a long time, that pay good dividends, and they really haven't been caught up in this sort of, I guess, investor enthusiasm we've seen over the past. So interesting times, but for investors like us, there's still lots of companies out there on very reasonable valuations that pay really good dividends.
So what's important now for IML and the investment team when you're putting portfolios together?
So if we look at the two biggest risks today, being inflation and interest rates going up, we really think it's important. There's two things that are really important. The first one is that the companies you own in your portfolio, the valuations of those companies have to make sense. Because if interest rates are on the rise, those valuations are going to be tested. Interest rates sort of work like gravity for valuations. So the higher the interest rates go, the bigger the impact on the valuation. And because we're coming off a zero base, even little rises in interest rates have quite a big impact on valuations. So number one, the valuations of all the stocks in your portfolio have to make sense. And the second one is, if we're going to have strong inflation that persists, you really need to be invested in good quality companies which have a strong competitive advantage, which can pass on any inflationary cost pressure. So they have to have some degree of pricing power. And that can come in many forms. It can be contractual, so you can be investing in companies which have CPI pass-throughs every year, or it can be a company that owns a product or a service that is differentiated and they can pass through price increases each year because that product or service is special. So they're really the two big things we think is really important right now.
And in many ways, that's the heart of the message, where things have changed in a rising rate environment. When rates are falling, quality doesn't matter too much in some instances, nor does valuation. And that's a significant change that investors need to understand.
Yeah, absolutely. I think momentum yeah, works. Momentum investing, works whenever interest rates continuously falling, and quantitative easing is continuing at a pace. But when you have those sort of tailwinds removed, really the company fundamentals, really come to the fore. And I guess we really find out, who's been swimming naked when those tailwinds are removed.
Daniel, has IML been surprised by the volatility that we've seen in the early part of 2022?
I guess the surprise is it's taken probably this long. It's probably the biggest surprise for us. We've been calling for caution for a period of time, given the interest rates and the valuations we've been seeing, and the speculative behaviour. It's gone probably beyond what we thought was possible. So we've been cautious for a period of time, and really been, I guess, hammering home the need to be invested in good quality companies that have a strong competitive advantage, that have real earnings, that pay dividends, with good management and a strong balance sheet. I guess we've been preaching this for quite a period of time. So yeah, I guess maybe things are starting to change now, but it's inevitable. Markets always go through these cycles. And this one's just been a very long one.
Can you share with us a couple of good stocks that meet the criteria that you've spoken of already?
The first one is Horizon, which is the old Queensland rail business, and it owns the rail network in Queensland. It's a monopoly which holds mainly metallurgical coal for steel, and they also own an above rail business, which is essentially the wagons that go on the rail, and they lease those out to the miners. And their customers are a combination of metallurgical coal for steel, thermal coal, and also bulk. And bulk's everything grains to copper, iron ore, a whole range of things. Now this company is really been put in the sin bin because of its thermal coal exposure, and it's currently trading on a multiple of 11 times cash flow. Incredible numbers. Its dividend yield is over 8% as well, and it's got a strong balance sheet, very strong assets. It has no remediation liabilities at all. And when you start to break up the different parts of the business, you can really see how cheap the company is, because putting the sort of whole negative coal slant on the business is probably a bit simplistic. When you look at the rail business in Queensland services metallurgical coal for steel, that asset's got a 25, 30-year life, and it's a regulated return. It's a very steady return, and it has inflation-protected returns. We think that's a phenomenal asset, which definitely should not be trading on 11 times. And then the second stock is Orica, which is the world's largest explosives company, operations around the world, and their share price has been hit because of COVID impacts, where COVID's impacted mining volumes, and initially explosive prices fell as well. But today it's trading on around 13 times its pre-COVID earnings. And what we're seeing is mining volumes recover dramatically, and actually explosive prices today are higher than they were pre-COVID. And the outlook for growth over the next 3 to 5 years is very strong on the back of a number of their technology and software products. But one thing we do know is when markets fall, companies that pay good solid dividends tend to hold up much better, because they're providing something tangible to investors, and that becomes much to the forefront of people's minds when markets are falling.